Hi, thank you all for attending and giving up your time on this lovely sunny evening. My name's Lisa Bangs and I'm Senior Organiser in London. So I have responsibility for schools and academies. And we're joined this evening by Georgiou, who is National Officer and our Pensions Officer. So we've got an expert with us for the evening. So hopefully you'll all make the most and get your questions that you might have about your pension answered. So we've arranged this meeting to explain how the local government pension scheme works, and hopefully it will give you an improved understanding of your pension and how it will work for you. I just have to say from the outset that this meeting is being recorded and we will share it with members afterwards. The format of this evening, I can see we've still got a few people joining us, so we'll give it a couple of minutes. But what we'll do is George will do a short presentation for us on the LGPS, and then we will open up to you if you have any questions. There's been a few questions submitted ahead of the webinar this evening, and I'll go through those with George. But if you have any questions that you'd like answered, you can either raise your hand if you're happy to speak to us directly, or you can pop a question in the chat. If we don't get a chance to answer any of your questions, or if you have a particularly individual question relating to your circumstances, you can speak to George, or you can contact George after this evening's webinar. Okay, thank you. If I can hand over to you, George. Thank you.
Good evening, everybody. I'm Georgiou. I'm the National Pensions Organiser for the GMB. I am basically the pensions department of the union. I'm going to give you a short 5 minutes of how the local government pension scheme works. I've not got a formal presentation, but I have got one, which Lisa will distribute to you all by email after the meeting. And if you do have any questions, either raise your hand, put them in the chat, and I'll try and answer them. On the presentation is my email address and my mobile phone number. Please, you are free to contact me in either of those ways at your leisure if you have any other questions. So on the local government pension scheme, the local government pension scheme is one pension scheme, and it is in two sections. It's in the pre-2014 section and the post-2014 section. And when you come to retire, what you've got in the pre-2014 section just gets added to what you've got in the post-2014 section, and that forms your pension. And when you get your pension statement, we refer to the pre-2014 section as section A and the post-2014 section as section B, and you will just get a piece of paper that says section A, this much, section B, this much, section C, which is sections A plus B, you will get this much. And the reason it's in two sections is that the scheme rules were changed back in 2014, and the scheme stopped being a final salary scheme whereby your pension was based on your final salary, and it moved to being a career average scheme where instead of it being based on your final salary, it's based on your annual salary. So each year, 1/49th of your annual salary is taken and put into your pension pot. It's revalued by inflation, and over time that builds up to form your pension and gets added on to whatever you've got in the pre-2014 section. I hope that's simple enough. One pension scheme in two sections with slightly different rules in each one. You pay an amount into the scheme that's based on your salary. You pay between 5.5% and 12.5% of your salary into the pension scheme. Those who pay 5.5% are those who earn below £16,500 a year. Those who pay 12.5% are those who earn more than £187,000 a year. And yes, we do have members who earn over £187,000 a year, chief executives and all of that. But the contribution rates are graded so that the more you pay, the more you earn, the more you pay into the scheme. Okay. There are numerous benefits for being in the scheme. Everybody should be in the pension scheme. You should be in any pension scheme. You know, your pension is is your deferred wages, and it's the income you receive once you have retired. And you will need an income once you have retired because, generally speaking, you're too old or you're too ill to work and earn any money. So pensions are a workplace issue. We fight for increased pensions in the workplace, and we ask you to join the scheme and build up enough money to supplement your basic pension so that you have some sort of dignity in retirement. You get tax relief on the contributions that you pay into the scheme. That means before we take the money, if you didn't pay pension contributions, we'd tax you on your whole wage. But what we do is we take your pension contribution out of your wages and tax you on the remainder. So you pay a little bit less tax and a little bit less national insurance. So it's another advantage of being in the scheme. The retirement age in the scheme is your own personal state retirement age. For most of you, that will be 66 or 67, and that's the date that you can retire in the scheme. Now, as you well know, everybody's state retirement age is going up to 67 by 2027, and by then, everyone's retirement age in the scheme will be 67. But you can retire earlier in the scheme. You can retire up to 10 years before your state retirement age. So you can retire from the age of 57 onwards. You can retire from the age of 55 if you've got membership in the pre-2014 section. You can retire up to 10 years earlier, but if you do, for each year you retire early, your pension is reduced in value by about 4% per year. So if you were going to retire 10 years before your state retirement age at the age of 57, you would lose about 40% of the value of your pension. The way to look at that, though, is do you want to wait until you're 67 to get a pension of £100 a week, or are you prepared to take £60 a week from the age of 57? So you get less, but you get it for longer. And it's just a choice that people make, and there's plenty of doing that. You can also retire later than 67, but the maximum age you can stay in the scheme is 75. And if you stay beyond 67, your pension is increased in value by what we call a late retirement factor. And those factors are based on interest rates and general earnings, but they're generally around between 3 and 4% also. And we do have a lot of people who are in the scheme beyond the age of 67, and lots of people, for example, we have lock keepers whose accommodation is tied to their employment, and if they were to retire, they would lose their accommodation, so people stay in the scheme for that. But it's just part of the flexibilities of being in the NHS pension, of the LGPS pension scheme. You can add to your pension, and I think we've got a question about that later on, about how you can improve your pension, and I'll come to that when we answer the questions. You can pay AVCs, you can buy additional pension. If you are too ill to work, the scheme has an ill health retirement section. You can apply for ill health retirement and you're assessed by an independent medical panel to see whether you are fit to work or not. And if they find that you're not fit to work, there's rules around it, but you can get your unreduced pension earlier on the grounds of your illness. If you are made redundant and you are aged over 55, you are automatically given a full pension. There are death benefits in the scheme. In the event of your death while you are working, payments are made to your surviving nominated persons and to your children. If you have children, your children will get a pension equivalent to 25% of the pension that you would have received up until the age of 18, or 25% up until the age of 18 or up until the age of 23 if they are in full-time education. That's if you die while you're working. There's also what we call a death in retirement. And if you die within 10 years of retiring, a payment is made again to your nominated person. And it doesn't have to be a person. It can be more than one person, and it doesn't have to be a person. It can be a thing. You could give it to charity or something like that. And it's one of the reasons that we asked everyone to make sure that they go online and make sure their details are up to date. People get married, people get divorced, people move house, people want to change their wills and the rest of it. If you don't nominate someone, then nobody will get it, and that will be your money just sitting in the scheme. So it's another benefit that you get is the death benefit. I'm going to quickly stop there. I'm just basically saying that you're in the scheme. It's in 2 sections. It's worthwhile being in the scheme. There's flexibilities in the scheme. You pay an amount according to what you earn. and you can add to your pension. You can stay later, you can go early, you get money in the event of your death and money in the event of your ill health retirement. So that's a very broad brush strokes of how the scheme works. Lisa will send the slides around to give you a more detailed view, but I'm happy to take any questions as from now. And I think we've got some already in the chat, Lisa.
Yeah, we have, George. Thank you. We've got two people with their hand up. So if I just go and let Andrea ask her question. Andrea, do you have a question?
I can see that Andrea's muted. Maybe you have to unmute her.
Yeah, I've unmuted.
There you go. Hi, Andrea. I can't hear you, Andrea, if you're speaking. Maybe you could put your question in the chat.
Yeah. Okay. Let's see if Christine, did you have a question?
Yes, please. Hello there. I left this scheme, even though I left the Foreign Office in 2000. I was there in I was still attached to the pension scheme to 2006, apparently. My question is that do I get the pension starting from the age of 60, or do I need to stay till I'm 67?
Sorry, why was your old pension scheme in the Foreign Office?
In the Foreign Office, yes.
So you've got your what we call a deferred pensioner. You left the Foreign Office and you've got your pension in there. That's part of the civil service pension scheme.
Yeah.
Depending on when you joined the civil service scheme, okay, because also the civil service scheme rules changed in 2015. If you joined before then you can take your pension from 60. If you joined after 2015 in the Foreign Office, it's the same rules as here. You have to wait until the state retirement age. And if you take it before the state retirement age, your pension will be what we call actuarially reduced on the same basis that it is in the local government pension scheme. So as you left there in 2006, you must have joined before 2015. So you must be able to claim that pension from 60. And if you claim it before the age of 60, I know that you can claim it from 55 onwards. It would be the same. You could claim it and it would be reduced by about 3 to 4% for each year that you claim it before your retirement age.
Yeah, I started in March 1988.
Right. Well, it'll still be there. It'll still be there sitting there waiting for you to claim it. And you can claim it from the age of 55 onwards, and it would be a full pension at the age of 60.
Right, okay, that's lovely. Thank you.
Okay.
When I find out about when I did ask somebody a while ago to send me some details of how much I'm likely to get at the age of 60, but I haven't heard anything yet.
Is that from the civil service?
Yeah.
You can just go online onto My CSP. So it's capital M, small y, and then CSP for civil service pension. You just put your details in and there'll be a modeler on there that will give you a prediction of how much you will receive.
Oh, okay, I'll have a look at that. Thank you very much.
Okay.
Thanks, Christine. So we do have a couple of questions, George.
Yeah.
The ones that have come in this evening. Can you take a lump sum when you retire, even if this is early and have a reduced pension?
Yes, you can take a lump sum. Okay. So it's one pension scheme in two sections. In the pre-2014 section, you automatically get a lump sum of 3 times the value of your pension. So if your pension was going to be 5,000, you would automatically get a lump sum of 15,000. That's in the pre-2014 section. In the post-2014 section, you don't automatically get a lump sum. You have to buy a lump sum by using part of your pension. You can spend up to 25% of your pension to buy a lump sum. And for each pound of pension you give up, you get a £12 lump sum. So let's just say, for example, you were going to get a £10,000 pension in the post-2014 section. £10,000, you can give up to 25% of that to buy a lump sum. So you'd have a pension of £10,000 and no lump sum, Or you could give up 25% of it, that's £2,500, to reduce your pension to £7,500 a year. And you're going to buy a lump sum with the 2,500 at 12 to 1. So 2,500 times 12 is £30,000. So your options are you could have a pension of £10,000 and no lump sum, or a pension of £7,500 and a lump sum of £30,000. Or you could have anything in between. You don't have to take the full 25%. You could take 5%, 11%, 16%, whatever you want. Or you could say, I need another £11,000. So you give up enough pension to get your £11,000. And people do that because they work out, I don't know, they've got £6,000 to pay off their mortgage, or, you know, they want to pay the kids through university or something like that. So again, it's flexible. And whatever lump sum you take in the post-2014 section gets added on to whatever lump sum you've got in the pre-2014 section. So yes, you can take the lump sum at any time that you take your pension, regardless of your age. You know, you can go from the age of 57, and if you're taking your pension, you can choose to take a lump sum with it.
Thanks, George. Question that was submitted before this evening. If I transfer from one local authority to another, how do I transfer my pension?
Well, when you start with your new employer, that new employer will invite you to bring your pension over into the local government pension scheme. And they must invite you within the first month of you joining, and you have 1 year to join. Okay. So there I am. I work for Barking and I move to Lambeth. When I start at Lambeth, I will get a letter saying, welcome to Lambeth. Do you have a previous pension that you want to transfer into our scheme? You say yes or no. If you say yes, and say, right, do you want to transfer it in? Yes, you can transfer it in, and you must transfer it in within the first year. If you don't transfer it in with the first year, it's very, very difficult to transfer it in. You know, you've got to show just cause and reason and all the rest of it, or that the employer hasn't asked you. And most people do transfer it in just for the simple administrative convenience of then you've only got one pension to look after, rather than looking after your pension at Barking and your pension at Lambeth. So most people do it, and I'd advise doing it. It makes no financial difference to you. You know, it's just simply convenient to have it in one.
Lovely, thanks, George. And we've got another question from the floor. We've got Glenda with a question, so I'll.
Hi, Glenda. Can't hear you, Glenda.
Hello?
Hi,
Yes.
Glenda. Have you got a question?
Oh, good. Yes. I joined first of all in 1988 and left in 2014. And then I rejoined the pension scheme in 2012 I left. And then I rejoined in 2014. So I have these two different pensions going on. Am I right in thinking that I therefore have two different pension ages? Can I kind of claim the first one? I think it was a younger age, maybe from 65.
You have got two different pensions, and you have got two different retirement ages. The pension that you left in 2012 has got a retirement age of 60. So you can pick that pension up from the age of 60. And the pension that you're in now, the one that you joined in 2014, that's the new post-2014 section of the scheme. And that's got a retirement section. That's got a retirement age of whatever your state retirement age is, which is 66 or 67. So yes, you've got two different pensions with two different retirement ages.
Thank you. But the first one you said 60.
Yes. The pre-2014 section has a retirement age of 60.
Oh, wow. Thank you. That's
Okay.
very good to know.
Yeah. Good luck.
Thank you.
Thanks, Glenda. And we've got another question from Karen.
Hi, Karen.
Good evening. My husband's going to speak on my behalf, if that's okay. His name's
Fine.
Mark.
Hello, mate. Yeah,
Hello.
what it is my wife's potentially looking at retirement through ill health. We've got a figure of what she would get if she got a pension now, but as you said earlier, through ill health, she wouldn't get any penalties on that. Is there any way we can find out how can we work out what that pension would be worth? We know what it's worth now if she takes it now, but what would penalty big or?
You'd have to contact the fund to ask that, because what the
Okay.
modeler does, the one that's on the website. I mean, if you're putting your 67th birthday, it will give you an estimate for your pension that you'd get at maturity at your 67th birthday. If you put in
Oh, right.
if you put in the age of 62, it would put in the actuarial reduction factors. It wouldn't take into account the fact that you have gone on ill health retirement. You can sort of work it out on the back of a fag packet, because you lose about between 3 and 4% for each year you retire early. So you can add that back on, but it would be a rough estimate. And the best thing to do would be to contact the fund for a more detailed position.
Okay. Also, I heard you say that that lady had a pension that's going to be, she can get at 60. My wife's
Yeah.
in the same position. She's got two pensions.
Yeah.
It says one's deferred. Is that the pre?
Yeah.
pre
So the deferred pension, when did you defer that?
I think it was 2014.
Well, if it was before the 31st of March 2014, then that would have a retirement age of 60, and you could claim that from the age of 60. Because
Okay, thank you.
the new scheme came in on the 1st of April 2014.
Okay, thank you. I'll have a look. And
Okay.
in my pension on my modeler, it's got section A, I think, and it says a deferred pension there. Is there two deferred pension? Is there a deferred pension and a normal pension in my current pension?
Right. A deferred pension is if you before retirement age, let's just say you worked for the London Borough of Lambeth and you left in 2014 and did whatever and then went back and you didn't take your pension. Just the fact that it's sitting in the fund, we just call you a deferred pensioner, because the money is in your pension account, but you're not taking it, you're deferring taking it until your retirement age. So it's just a phrase that we use, deferred pensioner. It just means that you've got a pension in there, but you haven't claimed it yet.
Okay. Sorry, another question is, so I've always worked for the same authority. So
Yeah.
I didn't leave. So they deferred it, did they? Because the pension changed in 2014?
No, nobody's deferred it. The only way to defer it is by leaving the authority. So it doesn't quite add up what you've just told me. You've
No,
always worked. Have you had a break in service?
No, never.
You've carried on working throughout.
Yeah, I've worked there about 27 years and I've never had a break.
I'd have to have a look at what you were referring to that says deferred pensioner before I said anything else. So Lisa's got my email,
Yeah.
and if you send it over to me, and I'll have a look at it for you.
Thank you very
Thanks,
much,
George. Thanks,
Okay.
Karen. We've got a couple of questions around AVCs, George.
Yeah.
So I'll give you the couple that we've got and maybe you can cover them.
Yeah.
I'm 64. Is it too late to add additional AVCs? And then we've got, who do I need to contact to arrange additional contributions? And is there a minimum time? And also, if you do pay AVCs into your pension and you take a lump sum, does it come out of the AVCs first?
So the answer to the last question is no. The lump sum does not come out of your AVCs. Your AVCs are a separate little pensions pot that you build up. AVCs are additional voluntary contributions, is what it stands for, AVC, additional voluntary contribution. And they are for people who want to supplement their pension income. So you can take out an AVC. Who do you take it out with? You take it out with the pensions authority that you're with. So if you work for Barking or whoever, then you just go on their website, say you want to take out AVCs, and you just start there and then doing it. The authority provide the AVC provider. They don't all provide the same one, but it's an investment vehicle. There are a lot of advantages to AVCs. It's a tax-free form of investment, because same again, we take that money out of your wages and tax you on the remainder. So you pay a little bit less tax and a little bit less national insurance. It's completely flexible. You can put in as much or as little as you want. You could take out your AVC for, I don't know, £50 a month. But if you were a bit short that month or Christmas was coming, you could reduce that to £10 a month. Or you might get a pay rise, so you could increase it to £100 a month. And you can do that on a month-by-month basis. Just put as much in as you want. AVCs, basically, you're just investing in stocks and shares. It's a separate little pensions pot that you're building up. So why would you do that rather than put your money into an ISA in the bank or something? Generally speaking, stocks and shares return better than bank interest rates, but you'd have to go through all your assessment to risk. Obviously, shares go up and down. You know, banks pay 2 or 3%, 4% if you're lucky at the moment, whereas AVCs can return more than that. So it's flexible, it's tax-free, and it generally gives you a little bit more money. There's no age limit as to when you can apply for it. But, you know, if you're 64 and you're going to work until 67, you've got 3 more years to put in there. So you have to think to yourself, I'm going to put 3 more years in there. If I put £100 a month in there, that's £3,600. What's that going to return me over 3 years? Maybe 4,000 if I'm lucky, but shares might go down. So I might not even get my money back. So it's just one of those financial decisions you have to make for yourself, depending on what your attitude to risk is and what you sort of like, you know, see the future bring it in financial terms. But generally speaking, most people that take out AVCs don't regret it. No one ever regrets really putting more money into the pension scheme. Most people regret not putting enough in. So it's just a decision that you have to make for yourself, I'm afraid, that one.
Thank you, George. We've got quite a few hands up. If I can ask if you could keep your question quite general, if you do have something more specific and personal, it might be better to follow up with George afterwards, because I'm just conscious that we've got a lot of people online and quite a few questions. So if I can come to Diane now. Diane, have you got a question for George?
Hi, Diane.
Hello, can you hear us?
Yes, we can.
Yeah, is it possible for my husband to ask on my behalf, please?
Yeah, of course.
Thank you.
Yeah, my wife started working in 2005, and is currently employed at the same school and has not had any break in service, but she currently has 3 pensions. 2 of them are deferred. How could this be the case? And on the first one, which is a final salary scheme, her pension pot, the lump sum is less than what the annual salary, the pension is, which off the back of what you said, that just doesn't correlate.
That doesn't correlate. If she's always worked for the same school,
Yes.
and these 2 other deferred pensions are from that school, I think this is just a question of the terminology. And again, I'd have to have a look at what you're looking at to see what it says. It can't be deferred. You know, it's one pension. It's in 2 sections. Sometimes it's in 3 sections, depending on when you joined. But it all adds up to the one pension. So you've got Lisa will give you my email address later, and I'll have a look at that for you.
Thanks.
Just so you know,
Diane.
it's 3 separate books. So we get 3 separate books every year.
From the same authority?
Yeah.
And you've always had the same job? Oh,
Yep.
sorry, you've always worked for the same school with them?
Yeah.
I don't get that. I'd have to have a look at what you were looking at.
Okay.
Okay, so yeah, just get that to me and I'll try and answer that for you offline.
Thank you. And if we go to Billy, have you got a question, Billy?
Hi, Billy, can't hear you.
Hello.
Yep, hi.
Hiya. I started a pension in 2015. What age would I be able to take my pension out? Obviously, it's a long time yet, but that's the question I'm asking.
You're in the local government pension scheme, are you?
Yes, I work
So
in
you
school.
joined in 2015, so you must have joined the post-2014 section. Your retirement age will be 67, and so you can take your pension from the age of 57, but your pension will be reduced by about 4% for each year you take it early. So if you left 10 years early, you would lose about 40% of the value of your pension. But you could do that because you can, like I said, it's either £100 a week or 67, or do you want to take £60 a week from now? It's less, but you get it for longer.
Yeah, exactly. Yeah. It's a risk you take. It's a risk.
Exactly. Yeah.
Lovely.
So it's up to 10 years before your retirement age.
Thanks, Billy. Thank you. And if we move to Fatian, I hope I've said your name okay there. Is it Fatian? Thank you.
I can't hear you.
Just trying to unmute. Okay, we'll try Fatian again in a minute. Linda, are you there?
Can you hear me now?
Fatian, yes, I can hear you now.
Oh, okay.
Hi, the question I was going to ask you, I was working in a different school from the one I am now. It's in the same hall. When I joined this school, I got the pension scheme. I didn't merge it. I was told that after a year it would merge itself automatically. Is it true? Or I should call
No,
it?
you have to merge it within the first year of your employment. If it's beyond,
when I called the local government, she said to me that if you leave it after a year, it will the pension will merge together.
no, that's not right. You have to tell them that you want to merge it, and you have to tell them within the first year. And if they've told you that, they've given you the wrong information. If you do want to merge it, you can still merge it. It would be at the discretion of the fund. You would have to write to them, tell them that you want to merge it, and that the reason you didn't ask in the first year is that you were told that you didn't have to do anything.
Okay, no, I still have time because
okay.
I only started work in January, so yeah, until January.
Okay.
Yeah.
All right, so you've got time. No, you have to tell them. It's not automatic.
So what I have to do is call them, and then they have to send me a form, fill it up.
Speak to your employer. Tell them that's what you want to do. There's a form that you have to fill in.
Okay, fine. All right, thank you.
Okay.
Thanks for the question. And if we move to Linda. Are you there,
Hi, Linda.
Have you got a question, Linda?
Can't hear you, Linda. Sorry.
Okay. Okay, we'll try Linda again. We've got some other questions, George.
Yeah.
This, I think, is one everyone would like to know the answer to. How do I find out if I've paid enough for my retirement? And if not, how do I top it up before the deadline given by the government? I think you've touched on topping up, but how do we find out if we've got enough in our pension?
Well, there is no deadline given by the government. The only deadline you've got is your retirement age and the date that you take your pension. And the way you can find out how much you're going to get is you should get an annual benefit statement. It's more than likely that you will get that online. They've stopped sending out the paper ones now. And you just look at your annual benefit statement and it should spell out to you what you are going to get. If you haven't got an annual benefit statement or you haven't got one, go online and sort out your details, because it means they haven't got your address, they haven't got your email address, they've got the wrong name, or something's gone wrong. And while you're looking at your annual benefit statement, make sure that your details are up to date, in particular, those who you would like to leave your money to in the event of your death. Everybody should get an annual benefit statement every year, which should tell you how much pension you're going to get. If you're not getting one of them, get online to your fund, make sure that they've got all your correct details.
Thank you. And if we move to Asima, have you got a question?
Yeah.
Thank you.
Can you hear me?
Yes, we can hear you.
Yeah. I took flexi pension and carried on working. Would it have any effect on my pension later? I've taken the flexi already.
You've taken some pension already.
And I'm still working.
You're still working. And are you a member of and have you joined the pension scheme again?
Sorry. Yeah, I've joined it.
So you've got a pension, you're in receipt of a wage, and you're wondering what's going to happen in the event of your retirement. Well, the fact that you've got a pension already will not affect the pension that you're going to get when you retire. The main implication might be tax implications, because your income has gone up and down and you might go over the tax thresholds, and getting additional monies might also affect any benefits that you might be in receipt of. But generally speaking, the fact that you've got a pension will not affect the amount of pension you subsequently receive in your new pension.
All right. Okay.
Okay.
All right. Thank you.
Thank you for your question. And if we move to Beverly.
Hi, Beverly. Can't hear you, Beverly.
It's taking a while, I think, to unmute. Let's try again. There we go, Beverly.
Sorry, can you hear me?
Yeah.
Can now.
Oh, thank you. I have a deferred pension. What I wanted to know is, does it increase year on year if I leave it there until my retirement age?
Yeah, it goes up in line with inflation. Whatever the rate of inflation is on the 1st of September, it increases by that amount the following 1st of April.
Okay, thank you.
All right.
Thank you. Thanks, Beverly. And Deborah.
Hi, Deborah.
Have you got a question, Deborah, for George? Okay, we'll come back to Deborah. One of the questions we've got, George, is if you have a nest pension, can that be transferred into the LGPS?
Only at the discretion of LGPS. And as yet, I've not met an LGPS fund that has exercised the discretion to allow it. So even though in theory it's allowable, in practice, they've never done it. I don't know why.
Okay. Thank you. My job is split into different roles, so my pension is split into those different roles that I do. Does that make a difference? Is it less beneficial to have three, I suppose, as to the one pot?
It's just administratively more convenient to make sure that all your pension contributions are going into the same pot. Otherwise, you've got to look after the pension with the one job and the pension that you get with the other job, and you're looking after two pensions. Financially, it makes no difference to you, but people want to merge them for the simple administrative convenience of not having to chase two different annual benefit statements, filling in double the forms and stuff like that. So if you can, and if you can merge them, then you should. And it will be on your payslip, you have a pension membership number. And it's quite simple that, you just make sure that the pension membership number is the same on both your pay slips. You just phone up the fund and tell them what the situation is, and they should be able to manage that for you.
Lovely, thank you. Another question. I know it's early days, but do you think there will be any changes to the LGPS pension under the Labour government?
No, I don't think they will. And I've told them to keep their hands off and leave it alone, quite frankly. The local government pension scheme is one of the biggest pension funds in the world. It's got over £300 billion worth of assets in there. But on the same basis, it has them assets to pay the liabilities of the pensioners. And we invest that money in line with our fiduciary duty to ensure that members' pensions are paid. Now, I know that the Tory government wanted to borrow some of the fund to fund some of its policies like levelling up and all of that, which was a joke, and we just told them where to go. So far, the Labour Party has not said that. I don't expect it to say that. If it does, it will get a very robust answer from me that money is for our members' pensions and we invest it to make a return. We're not here to fund government policies. If they want to borrow it, then they've got to tell us what level of interest they're going to pay back. Okay. Yes, we've got money, but that money is for our pensions. But all the noises so far from the government are positive.
Lovely, thank you. A question about deferring again. If someone does defer their pension, can they then change their mind and claim it early?
Yeah, you can claim your pension at any time you want, whether it's a deferred pension or an active pension, as long as you do so within the rules of the scheme. And the rules of the scheme say that you can't claim it any more than 10 years before retirement. So you can't claim it at the age of 45, you can't claim at the age of 50, but you can claim it from the age of 57 onwards, and it would be reduced in line with the rules of the scheme, about 4% for each year you take it early.
Okay, thank you. And I think you've covered this one around retiring early. If someone's worked for a local authority for 34 years, I'm guessing that means they're in the pre-2014 scheme. Can they retire when they're 55? And who would be the best person to speak to for advice on that?
Okay, no one is in the pre-2014 scheme anymore. We closed the pre-2014 scheme and moved everyone into the post-2014 scheme. But you've still got your part of your pension in the pre-2014 scheme. And when you retire, it comes to, you add the two together to form your one pension. Now, if you have got service in the pre-2014 scheme, and that had a retirement age of 60, in that scheme, you could retire up to 5 years before retirement. So you could retire from the age of 55. So if you've got money in the pre-2014 section, you can retire from the age of 55 rather than being able to retire from the age of 57 in the post-2014. But again, if you retire early, your pension is reduced in line with the actuarial reduction factor of the scheme of about 4% for each year you retire early. So just to say that again, if you've not got any membership in the pre-2014 scheme, you can retire from the age of 57. If you have got membership in the pre-2014 scheme, you can retire from the age of 55. In both cases, your pension will be reduced by about 3 or 4% a year.
Lovely, thank you, George. Another question, is it possible to take some of the pension early in order to allow you to be able to reduce your hours and carry on working?
No. And the only way you can take your pension is to retire. Okay, that's the only way you can take your pension. But you can retire and go back to work. Okay, so then you'd be in receipt of a pension. There's nothing to stop you retiring. But if you want to retire and go back to work, you have to have the discussion with your employer. So I want to retire and come back, because it's at the employer's discretion as to whether they want you back or not. So yes, you can retire. That's the only way you can take your pension. Going back to work is a separate question.
Thank you. Is it worth buying back pension years, and is it capped?
We don't answer questions like that. That would be tantamount to independent financial advice. You can buy back year. The way to do that, some people just like look at their annual benefit statement. They say, oh, I'm only going to get £12,000 a year, and I know that I need 15. So you can buy the additional 3,000. It's another way of increasing your pension, either by AVCs or by what we call additional pension purchase. So let's just say you need another 3,000. Okay, you can buy that, and you can buy it in a one-off lump sum. You can buy it 12 equal installments, or in equal installments from the date that you apply for it until the date that you retire. However, it's expensive, and I know to buy an additional £7,500 per year will cost you about £90,000, £90,000. And if you think about it, that works out about 12 times more than the £7,500 per year. But you know, you're buying £7,500 a year for £90,000. As long as you live for more than 12 years, your quid's in. All right, where am I going to get £95,000 from? Plenty of people, you know, get an inheritance, or they're made redundant and get a big lump sum, and they don't know what to do with the money, so they can buy the additional pension. An extra £3,000 a year will cost you around about £40,000 a year. And the amount that it costs changes because it all depends on interest rates and stuff like that. So if you do want extra pension, which is different to buying the missing years, because you can't buy the missing years, you can just go online, see what you've got, see how much you're going to need, and then make a decision for yourself as to what you want to do.
Thank you, George. And I think that answers one of the other questions about, does GMB provide financial advice? And the answer is no, we don't.
No, but we do use independent financial advisors who provide a free service to GMB members, and they're called Quilter, you know, like a quilt you put on a bed, quilt with ER on the end of it, quilter. And then their number is 08000 85 85 90. I'm going to say that again, quilter on 08000 85 85 90. So if you did want some financial advice, let's just say you had an AVC and you got £10,000 out of it and you didn't know what to do with it, you'd phone up Quilter and they say, oh, we can do this for you, or can do that for you, and it'll cost you this much and you'll get a return of this much. And that'll be free because you're a GMB member. Once you've got that advice off them, you're then free to go to any other financial advisor, Liverpool, you know, one of the big like the Pru or Liverpool Victoria, and say, oh, I've just spoken to Quilter, and for this £10,000, they'll give me this, that, or the other. What can you do for me? So it's always worth phoning them first for a little estimate. It's a service that we provide for the GMB. Quilter 08000 85 85 90.
Thank you. Thanks, George. I will share that as well after the webinar. Couple of questions have come in regarding the 85-year rule or the rule of 85, and are there still 3 levels of ill health retirement?
So the rule of 85 no longer exists. It ended in 2014, but if you started before 2014, you may qualify for the rule of 85. And the rule of 85 says that if your age and length of membership in the scheme adds up to 85 or more, so if you were 50 years old, sorry, better not, if you were 60 years old and you had 25 years membership of the scheme, that would be 85. So you would qualify to take your pension under the rule of 85. But the rule of 85 is not as it used to be. It used to be automatic. If you met the rule of 85, you could leave with a full pension. But they've stopped doing that now, and you don't get a full pension anymore. You only get full membership until like 2006, and then they pay you 96% from like 2006 to 2010, and then 86%. So it'll entitles you to go, but you won't get a full pension. Sorry, it doesn't entitle you to go. It entitles you to apply to go. And at the end of the day, the employer has the discretion as to whether to let you go under the rule of 85 or not, because the rule of 85 was brought in as a cheap way of making people redundant back in the 70s. But, you know, the employer makes up the shortfall, but they just don't do that anymore. Plus, you don't get the full 100% of your pension. So even though you might qualify, you're best off having a look as to how much you might get if you went under the rule of 85. What was the second bit? Sorry, rule of 85 and
if there's still the 3 tiers of ill health retirement.
There are 3 tiers of ill health retirement. We're looking to abolish tier 3 because it costs a fortune to administer. So you've got tier 1. Tier 1 says you're medically unfit to do your job or any other job. And then they will give you your pension and enhance it. Tier 2 says you're unfit to do your job, but you could do some other job. So you get that a lot in the ambulance service where they're physically incapable of lifting a person anymore. So they put them in the call handler room. So then they would just give them their pension, but not enhance it. Tier 3 says, we're a bit unsure as to whether you're unfit to do your job or not. So we'll review you every 3 years. And it's just an administrative headache to do all of that. So we're looking to get rid of tier 3 and just have tier 1 and tier 2.
Thanks, George. We've got another question of, if you leave and start a new job that isn't part of the LGPS, can you still claim it can you still claim it early?
Yes, you
like
can.
The 57 or
yeah, as long as you meet the criteria of you are within 10 years of your retirement age, you can either take it, keep it in there as a deferred pension, or if your new scheme allows, transfer it into your new scheme.
Thank you. So I think George has covered quite a lot of ground there. As he said at the start of the webinar, he has prepared some slides. Some of the questions have been around where can more information be found, and that's information's available on the slides that we can share. And I'll share the contact details of Quilter that George was sharing with us earlier. Are there any other questions anyone would like to put directly to George? No, I think you've covered everything. Oh, let's see if we can
Deborah.
get Deborah this time. Are you there, Deborah? Are you there, Deborah?
Well, I can't hear Deborah, but she'll have my email address because it's
Yeah.
on the front page of them slides, so she can just email me directly or telephone me on my mobile, which is also on them slides.
Okay. Sahelia? Are you there? Have you got a question for George?
Hello.
Hi.
Hi. I was looking at my pension statement, just more payslip, and my pension contribution is says 6.5%. And I was looking online for employer contribution. It was saying usually go up to 4%. But the figures on my payslip is say the amount, the figures are 3 times what I'm paying. How does it work?
Well, that's right. The employers pay in between 18 and 20%. Right. What the employers have to do is you pay in a certain amount because it's what we call a defined benefit scheme. It gives you a pension that you know what that pension is because it's 1/49th of your annual salary times the number of years of employment. So it's going to pay you, let's just say, for example, it's going to pay you £10,000 a year, but the amount of your contributions might not add up to the equivalent of £10,000 a year. So the employers have to pay in the rest. So the employers pay in between 18 and 20% of your salary. It's a big contribution. It's an absolute overwhelming benefit of being in the local government pension scheme. You don't get that in the private sector. It's one of the things of the public sector. You'll rarely be as rich as you will get in the private sector. Accountants and computer people earn hundreds of thousands. Our GMB members earn on average between 20 and 36,000. You'll never be rich, but you'll be in a secure and stable pension scheme, and that the employers will make good any shortfall and ensure that your pension is paid. It's not invested in stocks and shares. We don't gamble on the stock market. We invest it in secure, risk-averse infrastructure projects that guarantee a return over time. So yes, you will pay about 6% and the employers will pay in whatever else it needs. But at the moment, it's between 18 and 26%, 18 and 20%, sorry.
Yeah, thank you so much. And that means when I reach my pension age, I'm getting the state pension plus from my work. Is that right?
Correct. Yeah, you will get this pension in addition to your state pension. State pension is payable from your state pension age, which for most people is 67. It's currently £220 a week, and it goes up by at least 2.5% every year.
Yeah. Thank you so much.
Thank
welcome.
you.
Thank you.
And we've just had 2 quick questions, George, maybe you could answer. Thank you. It's regard to lump sums. Are there any tax implications if you take your lump sum? And the other one is there a lump sum on the 2014 scheme?
There are no tax implications on the lump sum. The lump sum is tax-free, okay?
Yeah.
And that applies for the pre-2014. I think I said earlier, you get an automatic lump sum in the pre-2014 section. The post-2014 section, you don't get a lump sum. You have to buy a lump sum by giving up part of your pension. You can give up to 25% of your pension and you get 12 to 1.
Lovely. Thank you. Well, I think that's everyone's questions answered. Thank you all very much for your time and attending, and I hope you found it useful. I've got your email addresses from when you registered, so we will share with you the slides, George's contact details, the information about Quilter, and we will share a recording. We'll share the recording that's taken place this evening with you so that you can listen back if there were any particular answers that you wanted to listen to again. Thank you all very much. I hope you have a lovely evening and we'll catch up with you soon.
And it's goodbye from me.
Thank you.
Bye, everybody.
Bye-bye.